Hi there, I'm Maria Leali with Synchronous Solutions. Today I'm here with Rick Phelps, here to talk about the basics of throughput dollars. Let's get right into it, Rick.
Thank you, Maria. Yes, we're going to talk about the basics of throughput to dollars today and a little bit about cost accounting versus throughput accounting and why you need to be using throughput accounting, not cost accounting. We'll start with understanding the basics of the cost accounting model. In the cost accounting model, we have revenue coming in from the sale of our products, and we immediately break out the cost of the materials and the cost of the direct labor. And direct labor in this definition is the folks who are actually touching the parts and pieces. Okay. So revenue comes in, cost of goods sold is materials and direct labor, which leaves for the business gross profit. From gross profit, we pay the expenses, and there's usually fixed expenses and variable expenses. Uncle Sam and the states and the local governments take their part in taxes. And at the end of the long run in a little tiny spigot, there's your profits, right? And this is how most folks with any kind of business background view their business and how money flows. So I'm going to shrink that down a little bit, turn it on its end, and show you that that's exactly what your profit and loss statement is, right? Your revenue comes in as income. You got your cost of goods sold and materials and direct labor. What's left is gross profit. Got a bunch of expenses, a bucket load of them. You get your ordinary income before taxes and profit. So there's your P&L. This way of looking at business has some implications. Makes us think about things in a particular way. And so what it does is really makes us believe that there's a profit associated with every job, which can lead to us thinking, well, every job has a profit margin, and there's always, therefore, a fair profit margin. I ought to be able to get at least this much money for the work I do, right? Problem is, this cost accounting perspective was developed in the late 1800s, and the world looked a little bit different back then. In fact, it looked a lot like this, right? Been a while, unless you live in Amish country, that you've seen horse and carriages and trolleys and whatnot. The machine shops, first of all, you notice everybody's wearing a hat. All the men are wearing hats, right? Very different situation. And the most profound difference that had an implication here was all of these gentlemen here were paid on piece rate. If they made 100 parts, they got paid whatever the piece rate was times 100 parts. This picture disappeared, over 100 years ago now, with the labor movement and unionization, where piece rate went out the door in favor of hourly wages and benefits, right? So that perspective actually destroyed or is invalid because the direct labor portion of it, which was true when cost accounting was developed in terms of piece rates, it disappeared. That's no longer the case, right? Unless you pay all your people by square foot, you don't have actual direct labor. Right? And so this model turns out to be not helpful. And it's not helpful because it leads to this thinking about profit margins, and those thinking about profit margins creates a problem. So it turns out there isn't a profit associated with every job, and therefore there is actually not a fair profit margin. And for those of you who are competing and have somebody from way far away, maybe a few hundred miles away, selling product at ridiculously low prices in your region, you know this isn't true. Right. So what do we do? What are we going to do about fixing our mindset? And well, we have a simple model, and it's called throughput accounting. And we're going to start with the same type of revenue coming in. We're going to tee the joint off. But now, instead of having materials and direct labor costs, all we're going to do is take off the materials. And we refer to those materials as truly variable expenses. These are the expenses that if you didn't sell the job, you wouldn't buy the material, right? That's not wholly true on stocked products, but essentially you sell a job, you buy the materials, right? There is no direct labor. And then what's left over instead of gross profit now is T dollars or throughput dollars. And the throughput dollars are the money that stays in the business. So you can think of this as the money that goes to your suppliers, and T dollars as the money that goes to all the people you owe money to every month in that bucket load of bills, right? And so T dollars have got to fill up this bucket of your bills. And every month you start with an empty bucket, right? So every month you start filling your bank account so you can pay all your bills, right? And if you don't fill the bucket, you don't make money, which is to say none of the jobs that month had a profit margin, right? And that's kind of problematic. If you think every job has a profit and yet you make no money, something doesn't add up. And this is what doesn't add up. You need to overflow the bucket to have profits, which means the game you're in, the game of business that you're playing, isn't about margins. It's about flow. Can you get the money flowing through your business at a fast enough rate that you consistently overflow your bucket? And we could take that big bucket and add to it the profits and say, okay, in a typical month, we have 21 days. If we divide the operating expenses and the profits into 21 buckets, it would look like this. And what we would do is fill each bucket, and on the 21st day or the last day of the month, that bucket represents your profits if you're less than 5% net profit. By the way, if you're less than 5% net profit, you're in deep trouble. You may not realize it yet, but if you're not getting at least 10%, your business is at risk. And so you ought to have filled your OE bucket by the 19th day of your month, every month, to make sure that your company's making at least 10% net profit. Good companies are filling up and paying all their OE on the 18th day, and so they've got the 19th, 20th, and 21st, so they're above 10%. Really great companies are even earlier. So what determines if you will overfill the bucket and start generating profits in a time period? What one measure will tell you if you're going to be profitable? And it's a fairly simple measure. Are you ready? T dollars per day. And if you don't understand the flow rate of your jobs and the T dollars that are going through your business, you don't understand how your business makes money. And that could be really troubling and honestly disastrous for your business in the long term. So, what is your current production rate? What limits your business's ability to make money? Is it where you want it to maximize the return on your business? Are you setting, or how are you setting your throughput targets so that you make sure that every day you're producing enough work with enough T dollars to pay off all your bills and have profit at the end of the month? And last, does your target T dollars leverage what's known as the law of vacuum and drive the sales department to fill the pipeline? See, if you have a target for T dollars, let's say it's $20,000, and you're only flowing at 15,000, then there's a 5,000 hole in your business, right? And the law of vacuum, nature abhors a vacuum, right? And so you want to know that you're short of that and incentivize your sales department to fill up that vacuum and bring in the T dollars to overflow the bucket and bring in the profits of your business. That's the name of the game your business is in. T dollars, overflowing the bucket, making profits. Y'all have a great day.
Rick, this reminds me of your home life, right? You get a paycheck every month. You got to pay all your bills, your mortgage, keep the lights on, all that stuff. And then what's left over is what you get to keep, right? It's kind of like the same thing, right?
It's exactly the same thing. And that's kind of the funny thing. Smaller businesses, they intuitively know this because this really small business, when it's just you and a couple of folks fabricating countertops, you understand that, right? Because it's your budget. It's you don't have enough money to pay the truck payment. You don't pay the truck payment. You go out and find some work, right? Or you don't buy a new truck. It's somehow when we get larger in businesses that we complicate the crap out of things, and our accountant helps us do that by putting together profit and loss and talking about margins and all this other honestly nonsense. You need to do that stuff for taxes, but you don't do that analysis for making the business decisions in your business. That's what throughput accounting and throughput dollars are for.
Yeah. And if you want to learn more about throughput accounting and how your business makes money, check out Rick's 4-part mini series on how your business makes money.
Thank you, Maria.
Thanks, Rick.